Hi, my name is CH. I have worked as a managed investments product specialist in Singapore for over 15 years and would like to offer, through short video courses, the investments related knowledge that I have picked up throughout the years to anyone who is keen to learn more about investments. This video is part of a series of videos focusing on providing basic yet detailed knowledge on mutual funds for Singapore-based or Singapore-booked investors. This is the first video in a series of videos where we aim to go through the different strategy types of mutual funds. In this video, we will briefly talk about categorizing mutual fund strategies by asset class, then cover money market funds. Mutual funds as an investment product has existed for a long time, with Investopedia quoting the oldest and still active mutual fund was incepted in 1924. That's a century ago. The mutual funds universe has grown and evolved over time, and today it has a very wide variety of different types of funds and strategies that can cater to most investors' requirements globally. As long as there is a public and liquid investment market, fund providers will not hesitate to create a fund for that market in order to attract investors and gain market share. There are several ways to categorize mutual fund strategy types, and in this video, we will be using the asset classification approach, which is quite commonly used. Going by asset class, the most popular traditional classes are bonds and equities, and therefore we have bond funds, or also frequently termed as fixed income funds, and as well equity funds. Dialing down the risk, we also have money market funds that serve to represent cash-like allocations in a portfolio. Going beyond the traditional classes, we have the slightly more alternative or thematic classes, with commodity funds and real estate funds being the two most popular asset classes. These are not the true blue alternative funds, but are actually equity funds with a theme. Last but not least, combining several of these asset classes, typically starting with bonds and equities, gives us the multi-asset funds that have the highest flexibility and scope to invest. There are of course other ways to categorize mutual funds. However, going by asset class has been a popular and easy to understand approach for most investors. As mutual fund strategy types is a long topic, we will cover money market funds in this video, followed by other strategy types in more videos. Money market funds, as the name implies, aim to provide money market or savings deposit-like returns to investors. They normally invest in tranches of fixed deposits of varying maturity tenors and as well very short-term high-grade bonds that are typically less than 3 months to maturity. As they aim to mimic savings deposits, they are normally designed for a single currency exposure so that there is no currency risk involved. Money market funds generally produce returns that are similar to around 3-month to 1-year savings deposits rate in the long run. The returns, however, can potentially be disrupted if there are significant interest rate fluctuations in the short term, when the funds may need to adjust their portfolio holdings to reflect the rate changes. One key difference compared to other general mutual funds is that money market funds have the highest liquidity terms. Money market funds come with daily trading and settlement is usually on the same day, or at worst 1 day later, whereas normal mutual funds settle 3 to 5 days later. This high liquidity helps to facilitate daily adjustments efficiently for investors who use money market funds to manage their cash exposures in portfolios. Given money market funds have a simple and straightforward investment strategy, they also come with the lowest management fees compared to other general mutual funds. Money market funds used to have normal accumulation and distribution share classes like other general mutual funds. However, after going through multiple rate change periods, a glaring problem arose, which was that during low or negative interest rate periods, money market funds that paid distributions suffered NAV losses that were too much for investors to stomach, as that was no longer similar to cash or savings deposits. As a result, fund providers adopted different approaches to tackle this problem. Some fund providers stopped the distribution share classes and only provided accumulation share classes for their money market funds, so that the returns are directly reflected in the fund NAV. Some fund providers maintained the distribution share classes but kept the NAV fixed while letting the distributions fully reflect the returns. The rest left their funds unchanged. Therefore, when investing in money market funds, it is important to understand how this aspect of the fund strategy works. In summary, money market funds are suitable for investors looking to allocate to cash-like exposures and do not mind some returns uncertainty in exchange for high liquidity. They are most frequently used by institutional investors who have a long-term allocation to cash-like positions, but have also gained popularity over the years with some private and retail investors. Additionally, money market funds are also commonly used by the mutual funds for cash allocations for the same reasons. Last but not least, it is important for investors to note that money market funds, like other general mutual funds, have no returns guarantee. Therefore, for investors who need the certainty in returns, savings deposits is still the way to go. Some countries do provide specific regulations for money market funds compared to normal mutual funds. Hence, these money market funds may exist in a separate fund family of their own to cater for the associated regulations. Here is an example of a money market fund. This is the BNP Paribas US Dollars Money Market Fund Classic Accumulation Share Class. Its benchmark is the US dollar SOFR Secured Overnight Financing Rate, which is a standard interbank borrowing rate that can be used to reflect short-term savings deposit rates as well. As seen, the fund had no returns in 2020 to 2022, as the US interest rates were near zero then. And once the rate hikes happened, the fund started to deliver returns from mid-2022 onwards. You can see the fund's returns track closely to the benchmark performance in all periods. The fund holds mainly short-term bank commercial papers, and bulk of the positions mature in the 3-month to 1-year periods. This share class charges 0.5% management fees, which looks okay considering the recent returns of the fund, but it will be a challenge to attract investors during a low interest rate period. Hopefully, this video has provided you an overview on the different strategy types of mutual funds categorized by asset class, and also a better understanding of money market funds. This concludes this video. Do check out my other videos to find out and learn more about mutual funds. If you find this video useful and would like to see more related contents, please click on like and subscribe to the channel, as well as share this video to someone else that might find this useful too. Last but not least, if you spot any mistakes or inaccurate information in this video, or have any suggestions to help improve this video, please do drop a comment below. Thank you and have a great day.